Back in February, the MPC observed that the fog of Brexit was creating a series of tensions for UK businesses, households, and financial markets, and that all of this was occurring against a backdrop of considerable trade and financial pressures in the global economy. At that time, the short-term outlook for the UK economy was subdued, and the data was expected to be unusually volatile and potentially less informative than usual. But provided clarity emerged about the future relationship with the EU and the worst of global risks were avoided, the MPC expected that UK growth would pick up to above potential rates, domestic inflationary pressures would build gradually, and a modest ongoing withdrawal of monetary stimulus would be required to keep inflation sustainably at target at the policy horizon. The question is, what has changed since then? Well, from a global perspective, in recent months, global tensions have eased. In particular, there's been a marked easing in global financial conditions, triggered by revisions to monetary policy outlooks in major economies. In tandem, global risk sentiment has recovered, and this has spilled over to lower yields and to ease financial conditions in the United Kingdom. And there have also been signs that global trade is stabilizing, and trade tensions, at least for now, have abated somewhat. Partly as a result, activity appears to be stabilizing in the major economies. The hard data now suggests that global growth troughed towards the end of last year, and the survey data bottomed out shortly thereafter. Recent developments are consistent with the MPC's expectations for a modest pickup in global growth over the course of this year to around potential rates. In contrast to the more benign global backdrop, domestic tensions remain. And to get a sense of their consequences, it's helpful to review how the UK economy has performed relative to the MPC's forecast from February of last year. The headline result has been that growth has been bang on our expectations, but the components have been different. Employment and wage growth have meant consumption was stronger than anticipated, growing by 2% versus 1.5% expected. Offsetting that positive news, business investment fell by more than 2% rather than growing by 4%. And net trade subtracted 0.5% from the expansion instead of contributing 0.75 percentage point to growth. And it's this pattern that looks set to continue in the near term. The latest Business Investment Intentions Survey point to further declines over the next few quarters, and if that happens, that would mark the longest run of falling investment in the post-war era. Falling investment is weighing on productivity growth, boosting unit labor costs, and supporting domestically generated inflation. Unable to plan for their long-term future, UK businesses have focused on short-term Brexit contingency plans. Concerned about disruptions to trade given the potential March 29th cliff edge, companies on both sides of the channel brought forward production, pushing goods imports and exports with the EU to decade highs in the 3 months to February, despite the doldrums in both economies. According to our agent surveys, the proportion of UK firms with contingency plans in place has risen from about a half in February to around 3/4 at present. And stock building has been central to the plans of over 2/5 of those firms, boosting GDP in the first quarter. Nevertheless, it remains that companies are only as ready as they can be, and they expect a marked decline in the rate of growth, investment, and employment in the event of a hard Brexit. In recent surveys, firms expected their output would fall by 3.5% in the event of a no-deal, no-transition Brexit. Faced with the high option value of waiting for news about Brexit, companies in aggregate appear to have favored hiring over capital investment. As a result, the UK labor market has outperformed expectations over the past year, with employment and wage growth both surprising on the upside. The resulting strength in real income growth has supported consumption, which in turn has driven domestic demand. Four-quarter real income growth picked up further in the first quarter, and surveys of consumer confidence indicate that households remain relatively optimistic about their own personal financial prospects, despite being pessimistic about the overall economic situation. And that divergence may be one reason why the only area of household spending that is discernibly restrained by Brexit is the housing market, where transactions are currently somewhat subdued and prices are stagnating. In aggregate, first quarter growth is projected to come in 0.3 percentage points stronger than we had projected in the February inflation report. About half of that upside surprise could be due to the boost from Brexit-related stock building. Consistent with reports from our agents, the MPC expects a corresponding drag in the second quarter. Smoothing through this volatility, the underlying pace of growth is a touch stronger than the MPC had previously assessed, though it's still a little below potential, meaning that the current margin of slack in the economy is expected to widen a little in coming quarters. While financial markets remain sensitive to Brexit-related news, global developments appear to have driven the market curve for bank rate that underlies the MPC's projections. Expectations of policy rates in the United States and the euro area have fallen significantly since February, and market expectations for the path of bank rate have followed. That path currently implies that bank rate will rise to around 1% by the end of the forecast period, around 15 basis points lower than in the February report. As the MPC's inflation forecast suggests, this new market curve introduces an additional financial market tension to the one that already exists between the current level of sterling and the level that would be consistent with whatever Brexit outcome ultimately comes to pass. Now, at some point, the tensions between households, corporates, and financial markets will be reconciled. And in the MPC's projection, that resolution comes through our assumption of a smooth Brexit to an average outcome, resulting in a forecast that has two phases. In the first phase, and the first phase covers the balance of this year, growth remains modest, reflecting the continued drag from Brexit uncertainties and below potential global growth. And near-term inflation is expected to pop up above 2% in April, but then fall back below target, in large part reflecting moves in household energy prices and the still modest core services inflation. In the second phase, so over the balance of the forecast beyond 2019, as global growth stabilizes around potential rates and Brexit uncertainties wane, business investment growth recovers, the housing market improves, consumption continues to grow broadly in line with incomes, and aggregate demand picks up to above potential rates. Excess demand rises to slightly above 1% by the end of the forecast period, notably higher than in February, with the unemployment rate projected to decline to 3.5%. The emergence of excess demand leads to a strengthening of domestic inflationary pressures, more than offsetting the fading contribution from imports and energy prices, such that inflation rises above target in 2 years' time and continues rising through the end of the forecast period. At its meeting yesterday, the MPC agreed that the current stance of policy remains appropriate. We emphasized that the right path for monetary policy will depend on how those tensions between businesses, households, and financial markets are resolved, and the response of monetary policy to Brexit will depend on the balance of its effects on supply, demand, and the exchange rate. But the MPC's latest projections imply that the current market curve, used as a conditioning assumption for a forecast, is unequal to the task of meeting the MPC's remit. Based on the MPC's conditioning assumption of a smooth Brexit, the committee continues to judge that an ongoing tightening of monetary policy over the forecast period at a gradual pace and to a limited extent would be appropriate to return inflation sustainably to the 2% target at a conventional horizon.